So I just wanted to make a quick video today on MSTW's launch day because I know a lot of people are excited on MSTW, and I wanted to quickly just give my take on this ETF and maybe talk about what you can expect. Hopefully this could help some people understand better what MSTW is all about. Maybe some people want to invest in MSTW and they don't even know exactly how it's going to work. And I feel like people are excited, but they don't really know what Roundhill is all about. I wanted to compare MSTW to, for example, other products like stuff from YieldMax and from Rex shares. Let's just talk about MSTW for a second. MSTW is the same thing as all of their other weekly paying ETFs. So if we go on their page here, so what they have is weekly distributions. So they pay distributions every single week, offering a recurrent income stream for shareholders, obviously, and then enhanced exposure. So as we know from their other single stock weekly ETFs, they have amplified returns by targeting 120% of the underlying, a powerful combination. So MSTW provides a potential powerful combination of single stock leverage and weekly income. So here in their holdings, they're actually holding 75% of what seems to be like a call. These holdings should be updated today at market open. So we should be seeing a weekly swap here, as well as about 20% of the actual stock. So if we look, for example, at Robinhood's weekly ETF, they have 120% exposure to a weekly swap. They have exposure to the underlyings plus a weekly swap, and it sums up to 120%. So it seems like they're able to go all in on the weekly swap if they want to, or they could just hold 100% of the weekly swap and 25% or 20% of the actual stock. Now, what's interesting is I think that this is a misconception on Roundhill's weekly ETFs. How often do they pay distributions? Obviously on a weekly basis. Then they say, do Roundhill weekly pay ETFs sell options? And as you can see here, it clearly says no. Roundhill ETFs do not sell options. Instead, the fund offers uncapped leverage upside to the underlying reference asset. So then here the question is, how are the weekly distributions calculated for weekly pay ETFs? And they say that the weekly distributions are calculated each week based on a proprietary formula that incorporates the reference asset performance and implied volatility. So what does that mean? That means that if you're thinking and if you're excited and if you want to buy MSTR, you're going to get weekly income based on the performance of the underlying. They do not sell options. They do not sell covered calls. So your upside is not capped. How they work is basically they actually hold 20% of the underlying usually, and then 100% of a weekly swap. Then inside of that weekly swap, let's say, for example, MSTR goes up in the past week. At the end of the week, they're going to take out a percentage of that upside movement and they're going to pay it back to their shareholders. Basically, you're going to get paid based on the performance of the stock on the past week. So if it has a little bull run, Roundhill is going to sell a bit of shares essentially, and they're going to give it back to you. And that's how you get your weekly distributions. So your weekly distributions are not going to be option based, but they're going to be based on the performance of the stock. If the stock goes super high in a single week, the next week you're going to get a super high distribution. If the stock barely moves or goes down, you're going to get a super low distribution. Since the distributions are based on the price movements of the underlying, so here, for example, Apple, the distributions will be super variable. Why? Because on the weeks where Apple have good performance, on the weeks where the actual underlying Apple goes up a lot, you're going to have a huge distribution. And then on the weeks where Apple is sideways or is going down, you're going to have super low distributions. So here on July 15th, we got a big distribution. And now let's see at the Apple stock. If we go on the 6 months, here, as you can see, we got a nice rally of about 6%. And now the stock has been rallying. So this is why we got an increase in distributions because of that peak here. Here from the beginning of May to the beginning of June, the stock has been actually sideways or even down around 6%. And now if we look at the beginning of May to the beginning of June, as we can see, we had quite low distributions. And then that spike that I showed you on the Apple's chart gave us a higher distribution. So now what does that mean for people who want to invest into MSTW or who really like Roundhill products? What I'm trying to get to is that since Roundhill products, they're not trading options, the distributions that they're going to pay to the investors are not going to be as predictable as the distributions from Rex shares, for example, who write covered calls on half of their holdings and their leverage, or for example, Coney from YieldMax, who are writing basically covered call on 100% of the underlying. Since they're writing covered calls, They can play with the strike price and they can aim for the highest distributions without giving up too much upside, and that's what they're trying to do. If you're holding Coinbase weekly pair from Roundhill, what you're going to see is they're not writing covered calls, so your upside is not capped and your distributions are based on the performance of the stock. And if we look at Coinbase basically has been on a rally. So this means that people who are holding CoinW, they're going to see high distributions consistently, not because they're trading options in a good way, but because the stock is doing good and they're going to see upside. So that's the thing is, if you're invested into Roundhill, you're probably more of a bullish investor. So you buy that weekly pair, you probably want more upside than you want income. You don't care about the consistency of your distribution. So when the market is going to be lower and you hold a Roundhill weekly pay, you're going to have lower distributions than if you hold a product from YieldMax or from RexShare or from any other ETF provider that is doing covered calls on the underlyings, because covered calls, like I'm saying, you can play with the strike price and you can kind of know in advance how much premium you're going to get depending on your income goals. Actually, if you want to hold a weekly pay ETF in a bull market from Roundhill, you're going to outperform. As you can see, CoinW is the blue line. You're going to outperform Kony and Kui. And now I'll start them at the same time. And as you can see, CoinW from Roundhill is clearly outperforming RexShare and YieldMax because, as I said, when you have a nice bull run, Roundhill is always going to do better. Now, if we look at a stock that hasn't been doing so well, if we look at Tesla, for example, Tesla, as we can see, it's pretty much very rocky. So it's going down, going up, going down, going up. It's pretty much sideways. Nothing too crazy. We're not having a crazy bull run like we're having for Coinbase, for example. If we start at the same inception time, so they're all starting from the same moment, in a down market or in a sideways market, TSW is the one that is actually performing the worst because they're not writing covered calls. So if the underlying is going sideways or it's going down, they're not writing covered calls. So they can't really offset that loss on the share price. So you're going to see all the downside of your underlying and you're going to have less distributions compared to Tesla and TSII, which are basically going side by side because they're writing aggressive covered calls and they're kind of extracting as much income as possible from the underlying. So even though Tesla has been going down or is going sideways, they're able to kind of stick together and they're able to hold themselves up a bit. The reason why is because Tesla is still a very volatile stock. So when you're selling covered calls, you can make money off of the volatility of a stock, even though it's going down. Where, for example, WeeklyPay, they kind of just pay you every single week based on the performance of the stock. So it's really based on the share price and it's not based on options. It's very depending on the underlying performance. All right, guys, so that was it. Hopefully this helps you understand how MSTW is going to work. So just to give a little recap, the distributions you will get from holding MSTW are not distributions from covered calls. So that means that when the market is going up, they're going to pay you a portion of that upside. So it's kind of like holding MSTR and selling a bit of shares when you're up. Or if you look at MSTY or MSII, they actually write covered calls. So they're going to consistently generate option premium regardless of the market conditions. And the premium that you will receive will depend on their strategies and how aggressive their options are and the implied volatility. If you're someone who wants more consistent high income, MSTW is probably not the best for you. And I think that MSTW has its place in a portfolio. If you're really bullish on MSTR and you think that MSTR is going to keep going up and going up for the next few months, next few years, as we saw with Coinbase, MSTW is actually going to outperform the other ETFs that are writing covered calls. Where if, for example, you buy MSTW and then MSTR goes down, you would actually be doing better with MSTY or MSII, for example. So that was it, guys. Let me know in the comments, are you guys planning on buying MSTW? Personally, no. I'm a big fan of covered calls ETFs. I would stick with my covered call favorites like MSTY or any other providers, but I think that MSTW has its place in a portfolio. Someone who is more growth oriented and doesn't really care about those distributions. If the distributions for you or just a little bonus, just the little cherry on top of the cake, then that could be a good option for you. But if you're someone who wants as much income, has much yield in its portfolio, then maybe it's not the best for you. It really depends on the market performance. So MSTW, not as consistent distributions compared to MSTY or any covered call products. So that was it, guys. Until next time, take care.